And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. It is, of course, Monday. It is also the first trading day of November, and we've got 2 months to go, and my wife published the household calendar for the next 2 months. Yeah. November the 1st through the 23rd is Christmas. November 23rd through the 26th is Thanksgiving, because the kids are here. And then November 27th through the end of the year is Christmas. Again, yeah. So there is a brief break in Christmas for Thanksgiving, but I will say she does celebrate Thanksgiving. We have turkeys in front of our house, not live ones. They're inflatable turkeys.
Well, I'm glad we got this all straightened out.
Well, I know, but the quality of effort that goes into decorating for Thanksgiving is far outdone by the decorating for Christmas.
Unmatched.
So, yeah. So I mean, Thanksgiving gets a couple of inflatable turkeys. The house gets everything for Christmas.
Sure.
So yeah, it's we need more love for Thanksgiving. That's all I'm saying. It just does not get the respect that it needs. It's kind of like that redheaded stepchild, right? Uh-huh. Nobody talks about. Yeah, right. That's Thanksgiving. Yeah. Mm-hmm. Anyway, a couple of things going on this morning. Last Thursday, we didn't get to have a show because we had technical difficulties here in the studio, so we didn't get an update on kind of what happened with the Fed. So I wrote about it in this weekend's newsletter. So we'll talk a little bit about that this morning. Also, we'll talk about kind of what's going on with the markets as a whole right now. So we'll kind of get into all that this morning. But outside of that, economic data is still kind of on hold. Wherein the current government shutdown is now the second longest on record. The longest before this was 2018, where we had 35 days. But now this is very close to that. So we're likely going to set a record for the length of the government shutdown. But despite the government shutdown and the lack of economic data, really the impact has been mostly minimal. Been a few concerns about SNAP funding for food benefits. That should get straightened out here in the next day or so. Some money should start going back out for that. But outside of that, there's been very minimal impact. Markets are doing fine. The economy seems to be doing okay. Don't see any real disruptions of magnitude around. So kind of brings up the question is like, why do we need government? I'm just saying. But, outside of that, everything seems to be all right. So, but when it comes to markets continue to do fine, and when we are getting set up now for the last 2 months of the year. So we're through the bulk. We're about 80% of the way through the S&P 500 index reporting earnings. We got the vast majority of those guys done last week. That now opens the door back up for corporate buybacks. That should be $6 to $7 billion a day into year end. Portfolio managers are under position going into the end of the year as well. If you look at systemic trading, systemic traders are pretty fully allocated right now. That should be expected. It did come down a little bit last week. There's a little bit of degrossing last week. But discretionary traders and consolidated equity sentiment remains fairly negative at this point. So again, very underweight equities kind of going into the end of the year. So if this market does keep rallying, that's going to start to suck more of these assets kind of into the market. So again, just something to think about, particularly coming off of a very, very strong summer. So we had one of those kind of summer years where the markets did very, very well. And that kind of brings us to what you need to know before the bell this morning. This is a monthly chart of the S&P 500. So you'll notice that we have now gone 6 straight months in a row now of higher asset prices for the market. Now, that's not abnormal, but it's long. That's a very long stretch of positive monthly gains in the markets, and we do that from time to time. We've seen these before. We have had longer stretches. We've gone 7 months in a row back in 2021. We went a little bit longer stretch, about 9 months in a row back in 2017. But you kind of have to go back in time to find these longer stretches. Once you get to 6-7 months of advances in the markets in a row, you typically get a little bit of a pullback. Now, that doesn't mean that you have a very, like a huge, massive decline, right? I'm not saying that at all. Although that has happened, the last time we kind of had this very long stretch, we wound up in 2022. But you are going to get potentially a month here where the market does pull back. So again, the important thing about that is to always, kind of look at your portfolio, look at the risk you're taking. November, December, we could have a bit of a pullback. And we had a decently sloppy December and January last year. So again, it can happen. We're all kind of expecting the Santa Claus rally. I'm just saying that there are some risk here, at least worth paying attention to. Markets are very overbought on a momentum basis. They're very, very overbought on a relative strength basis as well. So again, when you kind of have these very big, kind of three things. One, big deviations from long-term moving averages. So when you start looking at the deviation currently between where the market is trading now and the 20-month moving average, it's almost 2 years. That's a pretty big gap. That's going to reverse here at some point, and you can kind of see back in history that it can stay that way for a while, but you eventually get these reversions back to the mean. That happens repeatedly, and it happens when you have these very big kind of overbought conditions in the market. So when you have these big overbought conditions, you typically get pullbacks to the means. That happens repeatedly through time. And again, we've kind of got that same setup right now. So the risk is that you're going to get at least a month where markets trade a little bit more sloppily. Is that this month? Is it next month? Don't know. You're in a very strong momentum run right now that can last for a while. So again, we could go 6, 7, 8 months. That's, it's not unprecedented to have 7, 8 months in a row, but we are getting to that point to where you're going to have a bit more stock volatility and pullbacks in the overall market. So at least something to be thinking about in terms of the risk you're taking in your portfolio. And I know right now it doesn't seem like there's much risk at all in the markets, but this is when you start building those risks. So again, you'll kind of think about taking profits, rebalancing risk, just do some repositioning, maybe add a little bit of defensive to your portfolio. Certainly couldn't hurt you at this point as well, particularly as we head into year end. That's what you need to know before the bell this morning. When we'll come back, we'll pick up and talk a little bit about kind of what happened with the Fed last week, what happened with the markets, and then, of course, we'll talk a little bit about the investor dilemma today as well. So don't go away. More of the Real Investment Show coming right up.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
And now, another page from the Real Investment Advisor's Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Back to the show this morning. So on Thursday, as I said, Michael Lewitz was here and we had some technical audio difficulties, so we weren't able to do a show on Thursday. So we didn't get a chance really to discuss the Fed's latest rate cut, and more importantly, the announcement of the end of QT, which is the period of quantitative tightening that we've been in here for a while. And while that's kind of important, markets didn't really pay a whole lot of attention to it. The markets did trade a little bit sloppily on Thursday and Friday. But pretty much it was kind of a buy the rumor, sell the news type outcome because, again, markets had run up pretty sharply going into the Fed's announcements. The Fed did cut rates by 25 basis points. And while not really a surprise, Mike and I have been talking about since the beginning of this year that after the Fed kind of reduced QE from $25 billion a month to $20 billion a month, or to $5 billion a month, it was just a function of time until they just ended it altogether. And that was what also happened at this last meeting. They did end QT. Now, they haven't started QE, which is where they're expanding their balance sheet, but they have stopped QT. So now what this does do is it adds a buyer to the bond market, because every month the Federal Reserve has bonds that are maturing, and as those bonds mature, they have to replace them. Now, two things here that are kind of important. One is that they have stopped the reduction of their quantitative tightening, or the reduction of their balance sheet in Treasury bonds, but not in mortgage-backed securities. They are also no longer going to buy mortgage-backed securities. They want the premise is now that they want to shift the entire balance of their portfolio to Treasuries rather than mortgage-backed securities. Now, this is a little bit important because the Fed has talked about before. They haven't said it was a mistake, but they kind of implied it was, that they should have not gotten into buying mortgage-backed securities, right? They did this back in 2008 to stabilize the housing market and the mortgage market. And then they kept buying mortgage-backed securities along the way, and they bought more of them during the 2020 kind of liquidity push, following the pandemic. But they now realize that was not something they should have done. And so now they're going to start reducing the mortgage-backed security side of their balance sheet entirely and the goal is to move everything into U.S. Treasuries. So that also benefits the Treasury market, because now, as mortgage-backed securities mature, they're going to be buying Treasuries instead as well. So this is going to potentially help keep rates more stabilized. It's kind of a form of yield curve control, but it's going to help keep rates more suppressed in the bond market and help liquidity with the Treasury market as well. So as the government needs to issue debt, there will be a ready buyer there to pick up those bonds. Now this is important. The Federal Reserve does not, and I'm writing a whole article on how monetary policy works. That'll be out next Friday. But the Fed does not buy debt from the government directly. There's kind of two myths that run around. The first is the Fed's buying bonds from the government. That's not true. The second is that the Fed prints money. That's also not true. So what really happens, and again, we'll go into more on this in the article next Friday, because we'll put the whole mechanism. I've got a whole graphic of the mechanism and how it works. But when the government needs to issue debt, and we've talked about before that nobody prints money, right? The only printer, quote unquote, that exists is at the Treasury, and that's just for currency that's put into circulation, right? So the ones, the 5s, the 10s, the 20s, the 50s, the 100s that are going around the marketplace if you spend cash, that's the only money, quote unquote, printing that goes on. But that money that's being printed was created by the debt issuance. So all money is lent into existence. This is crucially important. Nobody's printing money. We lend money into existence. So when the government needs money to meet their deficit spending, they do that by issuing debt. Who buys the debt? There are a group of 20 banks called the primary dealers. They go to auction. They're the ones that buy the debt. They have to buy the debt. If you're not going to buy the debt, you're no longer a primary dealer. You have to buy the debt at auction. So the auctions always get funded. So now the banks own the debt. Now this is where the mistake comes in for a lot of individuals that talk about the Fed printing money. The Fed doesn't print money. The Fed says, okay, Mr. Bank, the Bank of Brent, he's a primary dealer, and he's got Treasury bonds on his book. I say, okay, I'm the Federal Reserve. I'm going to buy the bonds from Brent's bank. And what I do is I do a accounting transaction result. So it's a digital transaction, ones and zeros. I credit his reserve account, and he gives me the bond. So he has increased reserves. I now have the bonds as the Fed. So as the Fed, I now hold the bonds on my balance sheet. I now remit so the government then pays the interest payments on the bonds. They come to the Federal Reserve. The Federal Reserve then remits those interest payments back to the Treasury. So there's a bit of a closed loop between that. But now Brent Bank has increased reserves, and he can now lend those reserves out into the economy. when he lends the money out into the economy, he creates money. So the banks create money and the government creates money through lending, because that's how all money's created. So this whole move, so circling back to QT, QE, so this whole move to now stop QE is a function that repo has, which is the reverse purchase operations with the banks. The collateral that is used for that is treasuries, and the lending rates have been popping up, showing some stress in the liquidity market. So one of the reasons that the Fed very likely ended QT is because of stress that we're seeing in the repo market. It's very similar to what we saw in 2019. In 2019, we saw the very same type of stress in the repo markets, and the Fed was very delayed in taking action. And it started to get a bit out of hand. Overnight lending rates were jumping to 7, 8, 9, 10% on guaranteed collateral, right? You have U.S. Treasuries on your books, and you're loaning U.S. Treasuries for overnight operations at 10%. It was just, there was a lot of stress there. So the Fed is seeing some early signs of stress. Furthermore, overall liquidity in the system has dropped from what they call abundant to ample. They want about $3 trillion worth of collateral in the system. And we had a whole lot more than that, following the pandemic. And we had what was called abundant, collateral or abundant liquidity. That's dropped to about $3 trillion, which is now kind of at their what they consider to be ample liquidity. And so because of that, there's now no longer a need, in their opinion. Again, I'm just relaying their opinions, but their opinion is that they no longer need to do QT at this point, even though the balance sheet has only shrunk to just a little bit below $7 trillion. Now, mind you, when we came into 2008, the balance sheet was around $800 billion. And we went to $9 trillion, and now we're down to a little bit less than $7 trillion, and we're now kind of stopping QE. So we never got back to where we were pre-financial crisis in terms of balance sheet requirements, right? So just something to kind of consider. But, that's kind of what happened. And why it happened, it was clearly one of the big drivers for the reduction of QT to basically nothing is this liquidity issue in the markets. And again, there has been some stresses, and what the Fed's trying to do is potentially get ahead of something else, something potentially breaking at this point and causing something else happening, and that they don't want to have occur. So, this is just kind of what happened last week. Again, none of this was by the way, none of this was a surprise. Everybody pretty much knew that this was going on. But here's a chart of just so you kind of put it into perspective. This is a chart. So the blue line is the Fed's balance sheet, and you can see that reduction that we had in the balance sheet during QT. Now you see that one little blip up. That was the Silicon Valley Bank crisis. But that's the reduction so far. And again, just slightly below $7 trillion on the balance sheet. Bank reserves, you can see below that, have also been tightening along with the balance sheet. So again, that's where that stress is starting to show up. And the last time we were kind of at these levels in terms of kind of the bank reserve balances was back in kind of 2015, 2016. And that was where we're getting to the Eurozone crisis and Brexit and kind of all that was going on. So again, that kind of gap in funding is potentially a problem. Now, the markets haven't minded much of this at all. Again, they're previous to 2020, there was a decently high correlation between the markets and Fed liquidity. So, Fed liquidity was being, loaned out by the banks into the markets. And even though this reduction in QT was reducing a lot of that liquidity, markets have just exploded over the course of the last, kind of 3 years in particular, because of all the money that we inject into the system. And that's all now wound up back in the markets, which is going to bring us here momentarily to our conversation today, which is talking about the investor dilemma. But, this is, again, none of this is a surprise. But as I said, that does kind of bring us to today's topic, which is talking about the investor dilemma and kind of keeping a mind back on that chart I just showed you, this explosion in the market, particularly since 2020. Because of all of this liquidity that was injected into the system has created kind of the Pavlovian effect for investors. And classical, if you go back to classical conditioning, Pavlov, did this experiment where he would ring a bell, and when he would ring a bell, the dogs would get food. And so he'd ring a bell, give the dogs food. Ring a bell, give the dogs food. So he was, applying this trigger to the dogs. And eventually he could ring the bell and the dogs would just start to salivate even though he didn't give them food. Because they were conditioned that every time they heard the bell that a food was coming. And so there was this response that occurred because of this. And the same thing has really happened to the markets over the last kind of 15 years, following the financial crisis. And I'm going to read to you a kind of a statement. And this was kind of the idea that occurred. So this was Steve Sosnick wrote this for Interactive Brokers, and this is what kind of sparked the idea for the article. And this article is posted on the website this morning. If you go to realinvestmentadvice.com, if you follow me on Substack at Lance Roberts, it's already I posted it already this morning. You can catch. I posted a link on Twitter as well at Lance Roberts. So anywhere you kind of follow me, I've already posted links for this article. But Steve Sosnick of Interactive Brokers wrote, the other morning someone asked me why we were trading higher. I made a flippant comment. They rang the opening bell. That's why. Taking that a step further, on a morning when stocks are higher on a rally that began modestly in the pre-market but accelerated rapidly after the regular session opened, it is reasonable to wonder whether there is indeed a Pavlovian quality to the current market environment. And so that was his joke, right? He said, well, they rang the bell. And so investors started to salivate because they heard the bell ring. And that's been a function now of what's happened over the last 15 years is that we've applied a neutral stimulus. So the neutral stimulus is the interventions. And that was repeatedly paired with a reward stimulus of markets going higher. So this is the Pavlovian experiments, ringing the bell, giving investors a result. So investors have now been conditioned to expect that if there's a crisis of any type, that the Fed's going to step in and bail them out. So why not take risk? Why not take risk? And that's really the definition of moral hazard. I wrote an article previously about moral hazard because Neil Kashkari made this flippant comment about, there's no moral hazard in the markets. It's all fine. The definition, and so I wrote that, I said, the Federal Reserve's well-intentioned interventions have created one of the modern finance's most powerful behavioral distortions, the conviction that there will always be a safety net. After the global financial crisis, zero interest rates and repeated rounds of quantitative easing conditioned investors to expect policy support would always return during volatility. Over time, that condition hardened into a reflex buy every dip because the Fed will not allow markets to fail. So what exactly is the definition of moral hazard? Moral hazard, the actual definition, if you look up moral hazard, it's noun. Economics. The lack of incentive to guard against risk when one is protected from its consequences, e.g. by insurance. And this is what investors now feel that they have. It's been an environment where I can take risk because there is no consequence. And if there is a consequence, that's okay. The Fed will bail me out of that mistake. This is a chart of companies with negative earnings versus companies with positive earnings. And you can see that companies with negative earnings are far outperforming those with positive earnings. Well, why wouldn't they? Again, I am completely protected now by insurance. So why not take on more risk where I don't have to worry about the risk of failure or the risk of being punished for making a bad investment choice. But this is also why we see things like 5 times leveraged ETFs. We see things like, call options exploding. The put call ratios are completely out of whack. 60% of all options volume is 0 days to expiration type trading, just simply speculation in the markets. And again, don't have to worry about that because A, markets just always go up, and B, there's nothing to worry about. This is the change in the liquidity index. It kind of explains this. You can see that following January 2020, there was this massive explosion. Sorry, my chart changed on me. There was this massive explosion back in 2020 with COVID of liquidity. So the liquidity index just absolutely exploded. Now, since then, markets have been absorbing this liquidity. And liquidity, despite the fact it's come down, is still very abundant, much more abundant than it was pre-2020. So you just had this massive surge higher in liquidity, and that liquidity is still flowing through the markets, and that's why markets continue to rally even because of other concerns. I know a lot of people are like, well, there's, valuations and all this. Well, there's so much liquidity in the market, it's got to go somewhere. And more importantly, we've had negative equity growth over the last 3 years in terms of the supply of equities, right? So if you take a look at the number of companies that are publicly traded in the markets, they're getting absorbed out of the markets by M&A. So we're seeing a lot of buyouts, companies going private, those type of things. Since 2000, we talked about this previously, but since 2000, the turn of the century, we had about 8,000 publicly traded big companies in the markets. That's down to 4,000 now. So you just extracted a lot of equity, companies that trade out of the markets, but yet you've massively increased the supply of money into it. So there's more money chasing fewer assets. So it's not surprising that markets have just kind of continued to explode here over the course of the last, few years, particularly since 2020. You just had this massive surge in markets. And, speaking of valuations, valuations are great about telling you about what forward returns are going to be. But in the short term, we've talked about this before, they're just simply a reflection of investor psychology. So yeah, we're currently trading at 40 times earnings, trailing earnings on, the CAPE ratio. And that's not surprising. If we just take a look at trailing operating PE, just the 1 year trailing operating PE, we see that it's it tracks to a large degree consumer confidence. That's not surprising. So this chart shows consumer confidence and higher stock prices. When they run the consumer confidence index, they ask people, what do you think stock prices will be in a year? And they say, oh, I think it'll be higher or lower. Right now, they all think it's going to be higher at some of the highest levels on record. In fact, it's at previous record levels of those thinking is forward outside of the spike we saw going into Liberation Day this year. But everybody thinks stock prices are going higher. So if everybody thinks stock prices are going higher, then of course I'm going to pay up for assets. Why wouldn't I? Again, there's no real concern here. The Fed's cutting rates. There's plenty of liquidity in the markets. Economic growth is okay. Earnings continue to kill it because we keep buying back all the shares. And we have AI, these 5 companies that are keeping the profit margins and earnings of the S&P 500 elevated. So it all kind of just plays out. And so there's no risk, right? And so if I have no risk, why not overpay for companies? Why not pay 15 times price to sales for a company? Why not pay 20 times price to sales for a company? Why not pay 100 times price to sales for a company? There's companies out there trading like that. But it's okay because it's all a bet right now on the future of AI. AI is going to solve everything. It's going to increase productivity. It's going to create all this revenue and profitability. And so far, that story seems to be holding up. We just went through earnings with the 5 megas, and they're massively increasing CapEx going into next year. Building more and more data centers, processing more and more data. We've got this interrelationship between NVIDIA and Oracle and OpenAI and everybody else in this very small group of companies all giving each other money to buy stuff from the other person. So it all on the surface, it all makes everything look very, very, very good. And so why not overpay for those valuations? What could possibly go wrong? And more importantly, if something does possibly go wrong, that's okay. The Fed's going to bail it out. But see, everything's not so great on the surface, because what we have to remember is that ultimately earnings for these companies, whether you're Amazon or Microsoft or wherever, you ultimately get your earnings from the revenue that is received from your consumers. Google gets ad revenue from companies that buy ads on Google. Well, the only reason companies buy ads on Google is to advertise their product to who? Consumers. So consumers buy the product, which gives the revenue to the companies to do ads, to place ads on Google. So there is at the end of the day, all revenue comes from consumption. So if you take a look at consumer confidence, as an example, consumers aren't doing so great overall. Now, this is a combined consumer confidence index. This combines the University of Michigan Consumer Sentiment Index and the Census Board Consumer Sentiment Index. There's some problems with the University of Michigan. It's become a bit broken over the last couple of years, in particular because of political biases that's affecting the overall index. So that's why I created a composite to try to smooth some of that out. But overall, consumers' confidence in the economy, their outlook, et cetera, getting weaker. So again, that's just something to pay attention to. And typically when consumer confidence is very high, that's where markets are doing well, because again, revenue's good, earnings good, economic growth is good, but that's not what consumers are telling us right now about the markets. Yet markets continue to go higher, again, because of all the liquidity in the markets. It's not surprising. And this investor attitude that there is no risk, why not? But ultimately, these things kind of matter. So, these are the kind of the consequences of what's happened over the last few years with the investor dilemma. Why not take the risk, right? This whole idea of moral hazard is important because at some point, the reality is that there's going to be a dip that investors try to buy, and it just keeps dipping for one reason or the other. There's a risk at some point that the Fed may come in for a rescue of something and the markets don't go up. Now, that's kind of hard to believe because it's always gone up before, but it's at least something worth considering in your portfolio. Despite the fact that fundamentals may be a boomer mentality, focusing on fundamentals. That used to be a thing that boomers focused on back in the day when they invested. Fundamentals do matter. It may not seem like fundamentals matter today because they don't right now, right? It's just about price momentum in the markets. But at some point, if there is a crack in the markets for whatever reason, fundamentals will matter. Money will gravitate back towards fundamentally strong companies that can withstand whatever's happening in the overall economy, whether it's a recession, whether it's a credit-related event, whatever it is. And there's certainly some cracks, in the markets. In the credit markets, we're seeing cracks in some of the subprime lending. Again, it's not become a major ordeal right now, but there's certainly some cracks there, at least worth noticing. Certainly some cracks on the economic side in terms of the consumer. Consumers certainly coming under more stress. So we're seeing that in some of the delinquency rates, et cetera. So there's certainly some cracks within the credit market that are worth paying attention to. So again, at some point, we may have a dip if one of these events occurs. And investors are going to be quick because they've been conditioned to immediately buy that dip, expecting markets just to turn right around and go back up, but then markets don't. And that dip becomes a more protracted correction within the overall markets. And, we also have to just learn to accept that markets are unpredictable. They seem very predictable right now. Look, this has been a despite March and April, which, it fascinates me how quickly investors forget about those downturns. I mean, I was flooded with phone calls in March and April about, the downturn in the markets and, why aren't we selling everything and getting out of markets? And, our portfolios are down 2-3%, markets are down 20. There's not a lot to worry about because we had prepared going into that cycle. But people forgot how much they were panicking now because, 2 months later, markets are back near all-time highs, and they're like, oh, what correction? I don't remember that. What? This year's been great. Right? We forget about these periods of volatility. Despite all this liquidity, despite the development of moral hazard, despite the fact that there has been an immediate reward for buying the dips, particularly this year. Buying the dip has had one of the biggest return years in the last 20 years. This year. All because of April, by the way. But you just have to learn to accept that the market is unpredictable, and at some point something will happen that will cause a larger mean reverting event. Now, I'm not talking about 50%. I'm not talking about a financial crisis, so don't go there. But 10, 15, 20% is not outside the realm of possibility. Again, we just had a 19% correction back in April, and people have forgotten the pain they felt when they went through that. And they assume that can't happen again. It's happened, so now it can't happen again, but it will. But 5 and 10% corrections are going to be very common. And even 5 and 10% corrections from current levels is going to feel pretty painful. And markets are down 5%, you're going to be starting to kind of rethink your portfolio strategy, right? This is where you've got to be careful because you need to expect these drawdowns in the markets because they're going to occur and understand that unpredictability is part of the market cycle. But again, while buying the dip has certainly worked up to this point, it doesn't mean that it always will. And this is why I just want you to be careful because investors have now become so accustomed to the buy every dip situation that they feel like that nothing can go wrong, right? This is how bull markets make us feel like we're smarter than we actually are. Oh, I just buy stuff and it goes up. There was this great TikTok I remember back in 2021 when we were really kind of in the height of that post-pandemic stimulus-driven bailout. This young couple was on TikTok and they go, our investing strategy is very simple. We just buy stuff that goes up and that's our strategy. We all laughed about it then, but they were right? You just buy stuff that goes up and you make money. Problem is that we do two things in that environment. One, we buy things that are going up that necessarily should not be going up, and we eventually pay a price for that. And two, we forget to sell and take profits. The buying part is easy in a bull market. It's really easy to buy stuff in a bull market where things are just going up. What becomes much more challenging in a bull market is understanding when to also sell it. And I don't mean sell everything necessarily, but learn to take profits, learn to rebalance risk, those type of things. Those very mundane, boring things that go on in the marketplace that are part of portfolio management over time and helps you survive the eventual market downturns. And I know, market downturn, crazy talk, right? Downturn in the market can't happen. It's all going to be great. As I was saying during the open and bell this morning, we've gone 6 months straight without a down month. That's a fairly long stretch. There have been longer stretches, 7 and 8 months, but they're pretty uncommon. 6 months is getting pretty far out there on that limit of kind of monthly runs without a pullback. So we're going to get a correction here of some sort within the next couple of months. And you need to be kind of prepared for that. That'll also be an opportunity, right? If you have some cash, if you take some profits, rebalance some risk in your portfolio and raise a little bit of cash, you'll have that cash to invest at better prices. But that's part of the portfolio management strategy. And I know that's heresy to talk about, selling stuff in your portfolio, but that's part of the process. Anyway, this article's on the website. I posted it this morning talking about that. And one other thing. I posted an article on Friday also. I just wanted to, I'm not going to get into a lot of it. It's on the website now. But if you go to the website, realinvestmentadvice.com, click on the resources tab. Under our blog, we have blogs, financial guides, all those type of things on the website. But under the blog section, I posted one on kind of the 3 myths of gold that's going on, because I'm getting a lot of emails about really lots of different topics. One is that, there's been a few people out kind of saying, 60-40 allocations are dead. Your 40% bonds need to be Bitcoin and gold. That makes sense because, gold's been going up. It's had a terrific year. And whenever something has an acceleration in price, that gets a lot of people interested in it, right? So you start getting more and more speculative kind of action in the price of an asset. And that's been going on with gold. So I've been getting a lot of these emails. So I just wanted to run through I wrote an article about 3 myths about gold in particular that are being used by people wanting to sell you gold. So this is the big key, right? Which is gold's fine. We have portfolios that own gold in them. They're doing great. It's all good. So I'm not saying you shouldn't own gold. I'm not saying that at all. But there's a lot of myths being put out there in the markets about why gold is going up, and that have no factual basis. And generally the people purveying these myths are people trying to sell you gold at elevated prices, right? So they're making profits. You're buying an asset at an elevated price. One of these was put out by Statista, which I thought was interesting, but they pulled the data from another group. And it shows that foreign central bank reserves, gold versus U.S. Treasuries, this is a massive chart crime. This is simply the price of gold. It's not the quantity of gold owned. So what's been happening with interest rates? Interest rates went up, so bond prices came down. Gold prices went up, so gold prices went up. And so they're saying that the percentage of gold versus treasuries and foreign central bank reserves, and that central banks now own more gold than that's not true, right? It's just a function of price. So when gold prices eventually revert, and bonds go back up in price, then that's going to reverse. Here's the truth of the fact, and this is the differential of what's happening. So this chart is the actual quantity of gold, right? So what are the net purchases of actual gold versus the change in price? So over the last 5 years, the actual change in the amount of gold as a percentage of foreign reserves has risen about 5% in total. The rest of it is all price appreciation. So central banks have not been massively buying gold relative to treasuries. It's just that the price of gold has been going up. And when it comes to the actual purchase of treasuries, is at an all-time high. So foreign investors owning U.S. Treasuries has now eclipsed $9 trillion of U.S. Treasuries owned by foreigners, and those include central banks. So bring that chart up, Brent. So again, this whole thesis that nobody's buying, there's this whole myth that, foreign investors, central banks are dumping U.S. Treasuries. No, they're not. The reason it's going down is because because interest rates went up and bond prices went down. They're not selling massive amounts of treasuries, and they're not buying massive amounts of gold, but it's a function of price change. So again, they are buying gold, not denying that. They absolutely are doing it, but it's not to the degree that a lot of these purveyors of, selling you gold is trying to convince you that that's going on. The second thing is the whole debasement of the dollar. And we've talked about this briefly before, but this is a chart that everybody shows you and they go, it's a 90% decline in the purchasing power of the dollar. Yes, that is true. If you had all your dollars in cash in a jar underneath your bed back in 1960 and then never did anything with it. If you just held it, yes. Because what this chart shows you is just the purchasing power differential of the rise of inflation. That's all this is. It's just in the inflation adjustment. And inflation you have to have inflation in order to have economic growth. And that's why it's important that you invest your assets in something, whether you invest it in gold, whether you invest it in stocks or whether you invest it in bonds, you need to invest capital to protect the purchasing power parity of your dollar over time. And this is why we talk so much about investing capital over time. You have to get invested to create the purchasing power adjustment or that parity adjustment over time. But again, that's not debasement. You can't debase something that has no physical tie to it. So, I mean, it's just our currency is a function of economic growth. So as the economy grows, we have to increase the money supply. So again, as the money supply grows, and as long as the money supply is growing at a rate slower than gross domestic product, that's okay, right? Now, we did break that cycle during 2020 when we were sending checks to households. So money supply grew faster than the economy temporarily, but that's now kind of straightened itself out, And this is why if you take a look at money supply as a percentage of GDP, it's actually dropping. And that's because the economy is growing faster than the creation of the money supply in the markets. And again, we go back to our original conversation this morning. How is money supply created? Money is lent into existence. But if you don't have a growth in money supply, you don't have a growth in the economy. Money supply has to grow with the economy over time. So, again, these are kind of this whole idea of debasement and all these other things are myths that really aren't, and the money supply are really not backed by the financial data. So my point is, and the article covers all this, and it's on the website now, so you can just kind of download it, read it for yourself. But the important thing is just to remember that all assets go up in price. All assets also go down in price eventually because things change. If you get a strong U.S. dollar rally, you're going to have, that's going to change the dynamics. Money's going to flow into U.S. dollars versus other assets, right? So it's just, you have to understand that money moves relative to the market. So a lot of these theses that occur when an asset price, market's going up, it's all because of AI. Yeah, that's the thesis and that's the narrative, and that's certainly driving momentum in the stock market right now. That will change, right? Eventually. What happens in the bond market? What happens in commodities? What happens in any asset market? Those narratives change over time. So it's important just to understand that you need to understand the data behind the narrative. And does the data actually support the narrative, or is the narrative, and this is the important thing, this is all I want you to take away from this conversation this morning. The narrative that is being used to justify overpaying for an asset, any asset, is it valid? More importantly, is that narrative that's justifying the overpayment for an asset, any asset, Bitcoin, etc., is that narrative fundamentally backed? And if the answer to those questions is no, then you need to rethink about the risks you're taking within whatever asset class you're invested in. And that doesn't mean sell it all. It just means A, be more cautious, but B, understand your risk sizing within your portfolio. Saying, look, I know this asset's going up and the narrative says it's going up because of this, but that's not fundamentally backed. That will eventually crack because of the lack of fundamentals. So I need to manage that risk exposure in my portfolio. And that's why, we talk about rebalancing risk, again, taking profits, doing those type of things. In our portfolios that own a lot of precious metals, we took profits in those about a month ago. So now we've got cash to reinvest back into gold and precious metals during this corrective process. And we're probably not through that corrective process yet, but we're probably getting closer to the end of that than not. So this is why rebalancing risk becomes such an important and essential part of your portfolio management. And that goes through our whole conversation this morning, whether it's, talking about investor dilemma, or whether it's talking about, the Fed's QE, QT, whatever it is. These all have implications for different assets. And all has implications about what happens next within the market. So we just want to be careful about that and manage that risk accordingly. Okay, enough lecture this morning. All right, class is over. You're dismissed for the day. We'll be back tomorrow with Two Dads on Money. And, of course, with John Penn. Be sure you're by the website, realinvestmentadvice.com. That's realinvestmentadvice.com. Be sure and like and subscribe to the channel this morning. Certainly appreciate your support here very much. It's always very helpful. Send me your questions, comments, emails. Love getting them. We answer them all. Make sure that everything's getting taken care of. So, again, have a great day. Realinvestmentadvice.com. See you back here tomorrow.